Hello, and welcome to this episode of The Financial Translator, where we discuss financial topics in layman's terms to move you from confusion to confidence on a given topic. I am your host, Kirk Kreckmeyer, the Principal Advisor at Pebble Valley Wealth Management. We are a fee-only financial advisory firm helping our clients make informed decisions on their road toward financial security. You can find more information at pvwealthmgt.com. On today's show, I'm going to provide a market update with returns through the end of January. I also provide this market update as a blog post, which includes graphs, and you're going to also see those today on the screen if you're following along on video. As a brief legal disclaimer, our discussions here should not be construed as financial or investment advice, and each person's situation is unique. All right, let's go. And I guess for your regular listeners out there, if you find an old episode where I didn't include that last disclaimer, give us a call. The first person to call in, I'll send you a box of chocolates or something. So feel free to call in if you find it. Let me just know what the episode number was where I missed it. So jumping back to today's podcast, we're going to start with our usual graph. Those listening or watching the video, I should say, you'll see a table showing up on the screen. And it is going to give you the usual returns in table format. It shows you the last 1 month, happens to match year to date because this is the end of January here, and then the 3 and 5 year returns. When I was putting this blog post together, I was thinking, boy, it felt like a kind of a flat month, and it was for the U.S. large caps, although it was ended up being up 1.5, but definitely felt like a heavy month. But looking at the table, you'll see that it was actually a pretty strong month, actually a very strong month for some asset classes. So it definitely the market going on underneath, the S&P 500. Again, my blog post last month talked about the domination of those 10 top names. And I, cautioned, or not cautioned, but, if those names will pull back, you're going to see a pullback in the S&P. So definitely we had that this past month. But looking at the other asset classes and how they did, you'll see that small caps did very well, up 5.3%, REITs up 3%. International continued to rock like it did in 2025, up 5 and 8, close to 9% for emerging markets. And then down at the very bottom of the screen, you got the best and the worst. So the commodities were up 10.4, and crypto, Bitcoin specifically, using the Bitwise ETF, was down 4.3%. I guess a couple of quick more comments to go a bit deeper. On the commodity side, it shows 10.4. If you've been following the markets, you might have caught news of precious metals, and there was a big pullback. Commodities must be down this month, but they were just ripping higher leading up to this point. And so, the last day of the month, there was a big pullback, about 28% for silver, over 10% for gold, but it had such a strong 29 days before that, that it was still up pretty substantially. The biggest component of the month for commodities actually turned out to be energy. So just a little FYI there. And then crypto, definitely down. I'm recording this on Thursday, February the 5th, and markets in general, but crypto in particular, continues to get hit very hard. So for my clients, I guess look for a write-up coming from me in the next day or two on that. Now switching over on the screen, you're going to see on the graph is my usual year-to-date returns for different ETFs. A couple of caveats there for those looking at it. It's actually the last 13 months we're showing now, just because it's such a short, year-to-date wouldn't show much information. And so we show the last 13 months. And for you regular readers and watchers, you'll see, Crazy Kirk went back to his more detailed graphs. I can't help myself, but I went back to the more detailed breakout so we can see large versus small, REITs, international, developed. And so it's a bit busier graph, but a lot going on in the market. So it kind of tells a story for those who want to dig in. I guess looking at of anything of interest, again, kind of covered it already up above. The one thing you'll see, the dark green line on the graph, that is the commodity. And again, you'll see that very rapid rise, definitely, I guess, starting in November, December, but January, kind of parabolic. And then if you squint your eyes, you'll see that big pullback the last day of the month. Again, it was up year to date, just for the month alone, it was up 16.5 on the 29th and then 10% on the 30th. So part of that news, just FYI on the precious metals, the CME, the Chicago Mercantile Exchange, where futures are traded, where a lot of that stuff trades, they raised the margin requirements. And so people will trade these commodities they got to put up some collateral in case the market goes against them. They won't get the CME won't be hurt. But when things are very volatile or moving quickly, they sometimes raise those requirements. And it's leverage. People have leverage. They don't have the money to put up more, and so they have to sell what they hold to come up with the leverage, and that's what can compound the selling. So that was one driver. I'm not a precious metals expert, but that definitely added to the pain that was felt the last day of the month. So now switching over, the next graph on the screen here, we'll actually, I take that back. The next screen on the graph, yes, this is actually going to be one more equity-related graph. It's an old theme I've mentioned a few times over the years, and that is the infamous growth versus value. So on the screen, you will see actually 4 lines I added. Well, I'll explain that in a second. So the first line, look at the purple line. That's going to be your S&P 500, up 19.4%. And then I added the growth. I use the Vanguard as the ETFs to capture the growth versus value. So the orange line is the growth. You'll see it fell the hardest last April with tariffs, grew the strongest leading up to, call it October timeframe, and then stayed above. But then starting in the month of January here, value, which is the light blue line, was always, keeping up, but slower. And it definitely has picked up some steam in January. And then again, recording this the next couple of days here in February, but further dispersion going on here in the month of February. And then the green line I added in there, kind of a combination of both value and a factor, a dividend factor. It happens to be the Schwab dividend ETF, but value / dividend factor. And it's just pointing out that that definitely has been lagging substantially. It was pretty much flat throughout most of 2025. And again, you can see the big run. So it definitely caught some wind in the sails here in January. So again, just back to the components of the S&P 500. What is it made up of? And when the markets do change in the sentiment, you can see some strange things happening underneath. So that's why I had that for you there. So then switching over, I guess we're not done talking about equities. Again, a few more details in the graph, but hopefully you enjoy them. So now we're going to jump in and we're going to show you some graphs on the bonds. You'll, again, regular listeners and readers made a couple of changes here as well. So in the past, I would always show 5 years history, but it was always difficult to see the recent development. So as I was adding my comments or observations for the last month. So anyway, this time I'm showing you a 1-year graph, and then below that, a 30-year graph for much longer context. So right now, what we have on the screen is the 1-year graph. And you'll see I also dropped the 10-year tips. I still like it, still follow it, don't worry. But I was after granularity here, and by dropping that, I could get a bit more granularity for you, the listeners and users, to see more details. So that's what we have. A few comments that caught my attention. One, there was a jobs report, and inflation came out in January. The jobs report was a bit stronger than markets were expecting. Unemployment rate ticked up, if you recall, prior to that, fell back down. So what this means is, will the Fed keep cutting rates because the jobs market is falling apart, or is it maybe not so bad? So it's the latter part that the market reacted to when the unemployment rate fell back down. So the 2-year rate, which is the orange line on the graph, you can see drifted back up a bit. Again, maybe they won't cut as much, and so that's where you're going to see most of the market price action is going to be in the short end of the curve. Other things to note, I guess the credit markets. So the very top line, it's the magenta line now, is the BBB rated corporate index. If you squint your eyes, you can see it actually further tightened. The credit spreads tightened. So the difference between that and, say, the 10-year Treasury rate. So we're down to 78 basis points, which is quite tight. Now, again, some people who think it's not as big of a deal argue, and they're right, partially right, in that the credit market itself is much different now, a much better shape in terms of what companies, and how levered they are. I would argue that's more of a high yield story, maybe justifying tighter credit spreads on the high yield, but definitely the investment grade remains very tight. So, and then I guess the long, again, this is the first time everybody's seeing this 30-year history of the long graph. Now we're going to pop on the screen for you. Again, the main intent there, if you look at it, I guess what I was aware of it, but when you see it visually, it kind of reinforces or grabs your attention. The middle part of the graph, from 2008 until 2022, I guess, rates were very low. You call it 16 years. And so we have these currently relatively high rates, and that's true relative to the last 16 years. And if that's all most participants have experienced, it may seem like high rates right now, but this is definitely was an abnormal period, in my opinion, from the 2008 till 22 here. So the longer graph shows you, what rates were like prior to the great financial crisis. And so that's it for the bond graph. Now, again, those extra two graphs, hopefully the extra granularity helps you see with the wiggles and squiggles, if you will, for the last month or two in the market. So now the next usual topic I cover is the Federal Reserve. So there was the first Federal Reserve meeting concluded on January 28th, and no change in rates. And so it's currently at 3.5 to 3.75 range. No change in rates. Nothing real major. A couple of dissenters as expected. Dissenters meaning two of the voting members said they didn't want to not hold rates. They wanted to cut them by 25. But the interesting thing was the press conference. They always have a press conference afterward. And I have a link on my blog post. There's actually, you can go to the Federal Reserve website and they have a link to the transcript. So again, if you're don't have the desire or time to watch the actual press conference, but want to see some of the language, they do have the transcript there. A couple of things that caught my attention. So one, Chair Powell started the press conference, his fourth sentence in, and I'm going to just read the quote I have on my blog post here. While the job gains have remained low, the unemployment rate has shown some signs of stabilization and inflation remains somewhat elevated. So what that sentence captures is their dual mandate. How's the jobs market doing? He said that while, job gains look low, the unemployment rate has shown, has stabilized with that drop in rates. And so that's good. And then inflation does remain elevated. So they're saying, okay, we're going to keep rates here because you don't want to be cutting rates if inflation is high. So that was an interesting way of kind of saying, okay, we think we're neutral here. We got this dual mandate and, we have to balance both. And so right now, the way we're positioned, we think we're fine. In fact, another quote he had, we are well positioned to determine the extent and timing of additional adjustments. And so they're going to wait for incoming data and see where they go. The other interesting thing in the press conference, and so there, it goes for an hour or 45 minutes. People can ask questions, the reporters, and Powell was getting a lot of political and legal questions, just given the court cases against him, a Fed governor, and I guess those are the two main points. But his response, he pulled it up a few times, I should say. But I have nothing for you on that today, and he pulled it up a couple of times. Like, sorry, nothing on that for you today. So he definitely didn't want to step into it. It kind of reminded me of it was a few years ago now, or maybe multiple years ago, but Bill Belichick, former coach of the Patriots, he got his ass kicked in, I forget what team it was, but the next team they were playing was going to be Cincinnati Bengals. And his whole press conference was, we're on to Cincinnati. We're on to Cincinnati. So I just had a laugh when I saw Powell kind of pulling the same thing. So I do have like I said, a link on the blog post showing that transcript if you want. The other thing, I guess, is Kevin Warsh. And so this meeting concluded January 28th. January 30th is when Trump announced his nomination for the next Fed chair, Kevin Warsh. He used to be a Fed governor back in 2006, I think it was, till 2011. So he was on the Fed during the great financial crisis. And so he's been there, done that. So a strong candidate. There's discussions about how smooth his nomination will go. Will he get approved? I think he will. But anyway, that was announced after the Fed meeting, so there wasn't a whole lot of direct questions about Warsh because they didn't know at the time. And then finally, my special topic this month is going to be on mortgage rates. Again, if you flick back to the those graphs I showed you in Treasury rates, I always mention and mortgage rates will track the 10-year Treasury. But what's interesting now is on January the 8th, the administration, they're focused on affordability and trying to bring costs down where they can. And right now, mortgage rates have been relatively high. Again, if you go back to that 30-year graph, things have been higher, but they're focused on getting rates down if they can. And so on January the 8th, the administration announced a program where they directed the Freddie and Fannie, a couple of government agencies, to purchase an additional $200 billion of mortgage bonds. That may seem like a drop in the bucket given how large the mortgage bond market is, but that marginal buyer makes a difference. And there may be more behind it, more announcements behind it. So that impacted the difference, the spread between, 10-year Treasury rates and mortgage rates, mortgage bonds, which drive mortgage rates. And so we're showing you a graph on the screen now of a historic rates. And so I pulled this from the Fred, the economic database out of St. Louis. And I show the 30-year mortgage rates, which is the blue line, the 10-year Treasury rate, which I guess is the green there. Yeah, the green. And then the difference between the two is the red line. It goes back, I think, 20 years because the data dropped off before that. So I stopped there. But I guess the focus here today, and I guess one point to clarify, the mortgage rate here, don't look at that rate and say, hey, that's the rate I can go refinance at. This is just a weekly average. It's a weekly average from applications submitted to one of the agencies. And so some include points, some don't. They can't clean it out. So focus on the trend. That's the intent of that graph, but it gives you an idea of what current rates are at. But anyway, the focus on the difference between the two is that red line. And you can see it shot up quite a bit after the Fed started hiking rates. And it got up to be like, close to 2.5%, 3%. And so it has been drifting down, but relative to say 6 months ago, it dropped an extra 60 basis points, 0.6%. A lot of that coming after this program was announced. And so that's good news. And if you look back further, you can see back, prior to 2020, that tighter differential was even lower than it is today. So that this could be a program that could help mortgage rates come down. It's still going to be tied to the 10-year Treasury. And if the Treasury's rates go up and that spread stays the same, unfortunately, the mortgage rates won't come down, but worth watching and see if that can help the mortgage rates out there. So for you recent mortgage buyers, you probably have that, maybe maybe a 7 handle, probably not a 7 handle anymore. You could have refinanced to get out of that, but say 6 handles for sure. Watch these mortgage rates and make sure you have your refi person or your refi process ready to go, because I do think there might be some opportunities coming up. So that is a wrap on the markets. And so, the usual graphs and suspects, and then my special topics on mortgage rates and the spread between the two, which are important. So hopefully that was helpful. The extra graphs were a little different to give you some more information. And I guess, again, this is February the 5th here. So a couple of major sporting events coming up this weekend. I'm a big sports fan. So we got the opening Winter Olympics ceremony tomorrow night, and then the Super Bowl on Sunday. So if you enjoy the sporting events, make sure you watch those special events, watch the finest compete, and inspiring the young kids to inspire their dreams. All right, that's a wrap on today's topic. Thanks a lot. Thank you for listening to this episode of The Financial Translator. I hope this discussion helped clear up any confusion and will lead to more confident financial decisions. Thanks for your time, and be sure to check out all of our resources at pvwealthmgt.com. Until next time, go confidently.